Welcome to Trading Pro. In the previous tutorial video, we learned about simple pullbacks in a trend. Today, we will delve deeper into complex pullbacks in a trend. First, we need to understand, when does a trend make a simple pullback, and when does it make a complex pullback? Do you still remember what I mentioned in the last video? The prerequisite to participate in a simple pullback trade is, first, there must be a definite strong price movement, preferably breaking through a consolidation zone or a wave point substantially. Let me illustrate with this case. Here, we have a pattern of a second breakthrough entry into a long position after a simple pullback. Let's think about why this pattern holds. Why was it possible to make a simple pullback here? Why did the price continue to rise after the simple pullback? First, let's look at this sharp rise on the left. It was very strong. It had a strong bullish trend with long bodies of the candlesticks and minimal overlap. This strong rise broke through a bottom structure. Let's remove the following candlesticks for now. For the main market participants, seeing the sharp rise breaking through a bottom structure indicates that the bullish trend might have started. This is a signal. Therefore, they continue to buy during the subsequent minor pullback. They're not willing to wait for a lower position to enter the market. There's a sense of urgency here. Institutions are in a hurry to buy, so the price does not pause much, and it continues to rise after a simple pullback. Let's briefly explain this pattern of a second breakthrough entry. Many friends have doubts about this pattern. Let's first look at these three candlesticks during this decline, 2 bearish candlesticks and 1 doji. The highs of these three candlesticks are decreasing successively. The candlestick marked with the arrow is the first one to break through the high of the previous candlestick. It is the first breakthrough, labeled as higher high 1. The high and low of the substantial candlestick have decreased again. It was a failed breakthrough. Then let's look at the higher high 2 candlestick. It was the second candlestick during this decline that has a higher high than the previous candlestick. This is the second breakthrough. Can you understand? You need to understand the essence of price movement. What is the essence of the second breakthrough? In this case, it was the 2 exertions of the bulls. That's all about the second breakthrough. Let's look at a case of a complex pullback. The arrow marks a simple pullback, while the box marked with a rectangle is a complex pullback. In my analysis system, all consolidation patterns are referred to as pullback patterns. Why did the price continue to fall after a simple pullback at the arrow? Recall the knowledge I just mentioned. Before this, the price was in a range, and the subsequent strong fall broke through this range. At this point, the main participants in the market, whether bulls or bears, understood one thing. The possibility of the market falling further was higher. This round of simple pullback might be caused by some bears closing their positions, or it might be some contrarian participants entering the market. In this round of simple pullback, when the market reaches a reasonable price, major bearish institutions will aggressively enter the market. Therefore, the price continues to fall in the original trend direction. At this point, the opinions of the wave bear participants in the field are consistent. Regrettably, the trend continuation prompted by this round of simple pullback didn't get far before running out of energy, thus transitioning into a complex pullback. The question arises, why did the price undergo a complex pullback at this box? There are several reasons. 1. The bearish trend had been in play for an extended period. The major institutions that initiated the bearish market from the upper range have reaped substantial profits and are now gradually closing out their positions. 2. Contrarian traders, those poised on the sidelines ready to take long positions, found justifications for going long. An example of this could be the presence of an equidistant target for the decline. In summary, at the position indicated by the arrow, the viewpoints of the major institutions on both the bullish and bearish sides are aligned. They unanimously anticipate a drop in prices. However, when prices move to the range or box, their viewpoints diverge. Some bearish traders believe that the primary bearish institutions who have been driving the trend downwards would continue to short after taking profits at the bottom, pushing the price even lower. On the other hand, the bulls who have been watching from the sidelines finally see a solid bullish logic, and they actively participate in the market. Hence, there is a disagreement between the major institutions on both sides, leading to a standoff which results in a complex pullback. In simple terms, if the direction of price movement is clear and the major market participants agree, a simple pullback could form. At this time, the participants going with the trend would actively enter the market, while those against the trend would choose to watch from the sidelines. If the major market participants disagree on the market situation, resulting in differing judgments, a contest would ensue. Both bullish and bearish sides actively trade, leading to the possibility of a complex pullback. Complex pullbacks come in many forms, which I will briefly introduce today. In future videos, I will explain each pattern in detail and how to handle them. Some patterns look similar and don't have obvious differences. You could call them by this name or that name. The terminology isn't important. As I've always said, the key is to understand what they signify. Let's start by discussing the two-stage pullback, which is a very common pattern in market trends. We are currently looking at an hourly chart of Bitcoin. On the left side, there's a rapid uptrend followed by a two-stage pullback. This is where many people enter the market for long positions, and it also provides us with a second breakout entry candlestick. However, I might not take this trade because there are overlapping long candlesticks, which indicate a trading range. This overlapping pattern represents significant market uncertainty, and I prefer not to enter trades in such uncertain conditions. Here's an additional point of knowledge. After the two-stage pullback, the upward movement is actually a continuation of the previous uptrend, but the strength of this continuation diminishes near the previous high. When the potential energy of a trend that should have continued dissipates, it becomes a potential reversal pattern. I will discuss this pattern in detail in the section on reversals. Now, let's switch to an hourly chart of crude oil. The chart shows two instances of two-stage pullbacks. Some of you might wonder, didn't you mention earlier that pullbacks at moving averages are simple pullbacks? Well, the distinction between simple and complex pullbacks is not always clear-cut. In the hourly chart, it qualifies as a simple pullback, but if we switch to a smaller time frame, it becomes a two-stage complex pullback. However, these distinctions are not crucial. What matters is understanding what the market is doing. Here's a little piece of knowledge you can try to grasp. After a significant decline, we see the first pullback, and after the pullback, the price drop a little bit, which is actually a pullback of the previous pullback. After the pullback ends, the price continues to rise, extending the previous uptrend. As I mentioned before, after a pullback, the energy that should have sustained the original trend quickly dissipates. This leads to a potential reversal pattern that aligns with the overall market trend. Therefore, these types of trades are considered excellent opportunities. Now, let's talk about the three-stage pullback, which usually forms a wedge or channel. They are very common patterns in the market and provide excellent trading opportunities. We are currently looking at a 4-hour chart of the euro. I have a vivid memory of this trade because it yielded substantial profits. As a price action trader, you should be able to recognize the three-stage downtrend directly. On smaller time frames, it appears as a wedge. We will discuss how to trade wedges in future lessons. The pullbacks within a wedge pattern can offer high risk-reward ratios. Another common pullback pattern is the flag pattern or channel pattern. Why is it called a flag? Because it resembles a flag, with the previous rally being the flagpole and the subsequent consolidation forming the flag. After the price breaks out of this flag pattern, it continues in the direction of the previous trend. Trading flag patterns is also relatively easy. Entry is typically based on a breakout, or when the price touches the channel lines. For post-analysis, it is straightforward. We can see that the price broke above the flag pattern here, so it was a good opportunity to go long. However, in actual trading, there are a few considerations. First, you don't know which breakout is the true one. Second, even if you enter at the channel lines, your entry may fail. In that case, you need to wait for the next entry opportunity. As for the specific trading strategies for flag patterns, we will discuss them in detail in future videos. Lastly, let's discuss convergence adjustments and box adjustments, which are also commonly seen in the market. Traders should be familiar with these patterns, especially when trading Bitcoin. The two patterns I marked on the chart are both standard convergence patterns. However, personally, I don't trade these patterns frequently due to their two drawbacks. Firstly, when drawing the lines, they can have multiple interpretations, making it challenging to identify the exact breakout point. Secondly, false breakouts often occur, leading to frustrating trades. However, the advantage of these patterns is their classic nature. Many traders are involved in trading these patterns, making them highly effective. In live trading, pay attention to the breakouts of convergence patterns, as they often lead to rapid price movements. Box adjustments are also common consolidation patterns in the market, and I personally enjoy trading them. Most box breakout trades are straightforward. However, the box I marked on the chart is a bit special, and I would like to explain it in detail. What can you gather from this price action? Clearly, there was a significant upward movement here, followed by a pause and the formation of a box. It represents a trading range and reflects price uncertainty. This situation is quite awkward for a trader because the price can go either up or down with a 50 probability for each direction. Some may argue that there was a rapid rally followed by a box consolidation, suggesting a continuation pattern. In that case, the probability of further upside would be higher. However, I have to remind you that there was a clear swing point preceding the rapid price movement, and the subsequent pause may indicate the exhaustion of momentum. It is also possible for the price to break downwards, turning the box into an end formation. Therefore, as a trader, it becomes extremely challenging to make a decision at this point. This is what I often refer to as hindsight analysis, which is entirely different from actual trading. Many analysts present impressive explanations when analyzing past market movements, and beginners tend to find their videos logical and impressive. However, no matter how well they analyze past market movements, it doesn't guarantee profitability in actual trading. When trading, you're dealing with the current market conditions, not the completed ones. Alright, that wraps up today's lesson. We have covered various complex pullback patterns. In the next video, we will delve into the trading methods for these patterns in detail. Before we conclude, I'd like to mention something unrelated to the topic. Some people have asked me if my video course will cover a thorough analysis of Al Brooks' books. Well, that's not possible. Al Brooks' trading system is extensive, and he provides detailed explanations for various price behaviors. The combined word count of his 4 books exceeds 1.5 million words. I don't have the capacity to analyze such a massive system in its entirety. However, Al Brooks' approach to price action analysis has had a profound impact on the development of my own trading system. I will share the key points that I consider important. Nonetheless, even with that, it's only a small fraction of the knowledge covered in his books. Al Brooks' analysis system is vast and intricate, and much of it comes from his personal experience, which cannot be fully taught but must be accumulated through personal practice. And if you like this content, please like, comment, and subscribe so you won't miss out, and I'll see you in the next video.